The following presentation is intended for financial advisors only. This event may include statements that contain forward-looking information, and such statements may be subject to risks and uncertainties, some of which are significant in scope and by their nature beyond the controls of the investment advisor. There can be no assurance that such information will prove to be accurate, and historical results are not necessarily indicative of future performance.
Well, greetings, I'm Mike Hurley, Chief Market Strategist for NexPoint with your weekly market deep dive for May 10th, 2021. Well, some of the big news last week was in the commodity markets. Once again, we've been speaking for several weeks now about the strength in the Bloomberg Commodity Index. You can see the monthly chart on the left, as well as the weekly chart on the right, with 4 straight big up weeks. That's important, particularly when the move is driven by economically sensitive commodities such as copper, and even the agriculture commodities such as corn. Corn was up 9% last week, which was off the heels of a 10% up week the week before, and a 12% up week the week before that. So again, strong commodities is important because it signifies real growth around the world. This is, of course, being accompanied with a weak dollar. You can see the dollar failing at its 200-day average here in the center chart at the top, and approaching a very important long-term area of support. We believe that should the dollar break here, which is possible, if not likely, that it could kick off an entirely new aggressive round of inflation. Finally, what was particularly unique and different from the weeks prior was the strength in gold. For several quarters now, gold has remained under a punishing downtrend line, which it broke last week. That's important because, again, with all the talk of inflation out there in the world, you had not seen gold respond until last week. We think this is the start of a move, particularly given the Commitment of Traders report has such a bullish configuration. This is the level of shorting that people who actually pull gold out of the market have been doing, and it's at the lowest level in a year and a half. Finally, even looking better than gold has been silver. If you look at the green line below silver, that's a ratio of silver to gold. And the fact that it's been trending higher over the last year shows that silver has been relatively stronger, which you can see making higher highs when gold has been making lower highs than gold itself. So again, we think the time is particularly ripe for those who are interested in putting gold stocks in their portfolio. Looking a little deeper, we have a couple charts here that we presented from Bloomberg. One is the Dow Jones Industrial Average. It looked back about 20 years with the price of gold, and the Dow in gold ratio on the bottom, or think of this as just the Dow Jones Industrial Average divided by the price of gold. Typically, this has smooth trends, and it really tells you when you want to be in one asset class over the other. You can see that while the ratio has been strong lately, meaning gold weakness compared to Dow strength, that you didn't see a higher high, so no confirmed bull market or bear market in the shiny yellow metal. So the trend of the favoring gold over the Dow is still intact. The chart on the right also goes back about 20 years, but we have gold on the top and silver in the middle with the gold-silver ratio on the bottom. The reason we like to look at this is because usually gold markets begin and end when this ratio on the bottom is at an extreme level. You can see that we recently had an extreme move to 113. The low reading at 32 was back around 2012, just about the time gold was making an important top. So again, given that this ratio is still at 66 or 67, it suggests to us 2 things. 1, silver has a lot of room to play catch up to gold. And 2, the speculation involved in the market, which again is usually signaled when silver gets expensive compared to gold, is just nowhere in sight yet. Looking at bonds and interest rates, last week was a very interesting week in the interest rate market. If you look at the top left chart, which is a daily chart of the 10-year Treasury, you can see that the 10-year Treasury on Friday, based on that terrible jobs report, sold off, or bonds rallied and pushed yields down to 1.47%. That was in the morning, however, because by afternoon, yields had reversed entirely, and bonds have sold off their entire gain. That's important because, again, if a job report that week can't push yields lower and have people move into safe assets such as bonds, it really does show the strength of this interest rate move or the weakness in bonds, whichever way you want to look at it. If you look at the chart to the right, the weekly chart, you can see that yields also bounced off a very important support, which corresponds to those 2019 lows, which were broken here in early 2020. So again, a very natural area of support, which has in fact held. If you look at yields globally, we changed the left-hand chart this week to show yield curves around the globe. White is the US, blue is the UK, red is Japan, and the German yield curve is in yellow. The point being, all yield curves definitely have an upward slope and look healthy at this point in time. They're all slightly higher and slightly steeper than when we showed them last month, but really not materially. And again, just the shape of them is what's important. As for yields last week of the same markets, most of them were higher. In fact, the US was the only market that saw yields dip slightly, and it was down a small 5 basis points. The point being, if you look at this market over the past year, you've seen a strong move in yields higher, led by the US 10-year break even, and followed by US yields, British yields, and then again, those across the globe. While those were higher last week and ours were lower, ours continues to look like, again, a consolidation within an existing uptrend. Finally, I think it's notable that the biggest move higher last week was in the 10-year US break even. And again, that's important because that was the first indicator to lead this entire move in rates globally. Looking at credit spreads, they were also mixed on the week. You had CCC yields down 17 basis points to 484. And the reason that's a very interesting number is because it's the lowest number now on the chart. In fact, it's the first time CCC spreads have been below 5% to US Treasuries since 2007. So again, the lowest yield spread on record since the global financial crisis. High yield spreads were up slightly, 6 basis points. But again, last week, they were within 2 basis points of setting a new low on the chart as well. So in general, spreads remain tight, which is definitely a tailwind for stocks. Looking at the value line over the last 20 years, or roughly the last 20 years, we simplified our chart this week just a little bit. We're still showing the red and green vertical lines, which correspond to when the indicator at the bottom pane crosses above and below 40. That indicator on the bottom pane is the percentage of stocks above the 200-day average on the value line index. We use that as a long-term indicator to confirm bull and bear markets. And while it can lag every once in a while, like it did here in 2009, it does keep you on the right side of the major trend in most markets. We simplified it to only show 2 instances with the pink box or the magenta box, which I've now made a dotted outline. That's when that indicator on the bottom is above 80 and has been above 80 for an extended period of time. Right now, we're at the longest period of time that indicator has been above 80. And you can see that while the market is quote unquote overbought, it's been overbought for several thousand points on the value line index, which is again, good news longer term. The only other time this occurred was back in 2009 when it also stayed overbought for several quarters. And again, while the market was overbought, pulled back and held its 200-day average, it was definitely the early innings of the game in that market as well. Looking at a little more tactical picture, you can see the market was strong last week as measured by the S&P in that it got through resistance at 4,200 and moved to a new all-time high. You can also see that the stochastic indicator picked up and crossed as it did on the NASDAQ down here in the bottom left pane of the chart. That's an overbought, oversold indicator. And by crossing and moving higher, it suggests the bulls have the ball, at least over the short term. Remains to be seen how far they can move it down the field because we've got some other structural problems in the market. But again, over the short term, the bulls definitely have the ball. If you look at the weekly charts, however, while the NYSE has seen an increase in breadth and leadership, or the advanced decline line, and the number of new 52-week highs, the NASDAQ is seeing divergences in those same indicators. So again, an advanced decline line that's showing lower highs, and the number of new 52-week highs that's significantly drying up. So the question remains, or I should say the jury's still out, on whether the NASDAQ is going to pull the rest of the market into a consolidation, or whether the NASDAQ's going to get the memo and go to new highs and confirm those in the S&P. We're a little more along the camp that we're probably set up for a correction, particularly given the seasonality of the market right now and the summer months approaching, than the NASDAQ surging to all-time highs very decisively. If you look at the volatility surface, you can see that volatility did decline really across the board last week. So the top right chart is the difference in the curves from the 430 surface to the 5.7 surface. And again, really across the board, the curve dropped, which signified increased selling activity in both puts and calls. So most market participants are expecting the market to maintain a tight range with little volatility going forward. If you look at the sectors last week, what was interesting is that the market really did have an inflationary trend. The two best sectors on the week were energy and basic materials, which are, again, very inflationary oriented, that dovetails with our comments on commodities and the dollar. And also, you can see the value stocks continue to outpace the growth stocks. This is the second week in a row both the Russell 2000 Value ETF and the Russell 1000 Value ETF were higher, and the 1000 Growth and 2000 Growth were lower. So definitely an inflation theme to the markets. And you can also see it in the relative strength lines. If you look at the XLK or technology ETF, you can see the relative strength waning, a higher high but a lower high in relative strength. It suggests that the FANGs are not leading the market higher, but instead getting sold in favor of, guess what? Energy stocks, basic material stocks, and financial stocks, which all have improving relative strength. So there's very definitely a rotation going on in the market right now, and you can see it in these types of indicators. You can also see it in the skew lines, and by that I mean if you look at the three sectors across the bottom, you can see the skew for puts and calls confirms it in energy, financial, and silver. Starting with energy, call skew is high, meaning people are bidding up call spreads. It's low for put spreads, meaning they're not as interested in put spreads. Same for financials, a bullish configuration with puts higher than calls higher than puts. And the same with silver, which we mentioned earlier. You can see the skew for calls up in the 80% range and the skew for puts down below 20. So again, bullish configurations on the option markets for energy, financials, and silver as well. Looking at our large, small growth value model a little more in depth, you can see four charts on this collage. The two charts on the left are monthly charts, and the two charts on the right are weekly charts. The top two charts are the ratio between the Russell 2000 divided by Russell 1000, or the ratio of small stocks to large stocks. The bottom two charts are the ratio between the Russell 3000 growth and the Russell 3000 value, or growth stocks to value stocks. We use a simple moving average model to just figure out where the money is flowing in the market. And you can see an interesting phenomenon. The monthly charts are still in favor of large and growth, as evidenced by the red stripe and the green stripe. But the weekly charts, which are a little more nimble and tactical, are showing just the opposite, meaning small and value. We got the value signal on 319 just several weeks ago. So again, while the longer term monthly trends still like large cap growth stocks, the more nimble model is showing some changes in those trends, and they like the small value. So again, we may be seeing this setup for finally some changes in these longer term trends. And by longer term, I mean growth has been outperforming value for 13 years. There's been a lot of talk lately about now is value's time. We're not seeing it on the monthly charts yet, but we are seeing it on the weekly charts. Finally, as for the overseas markets, I know we showed monthly charts last week because it was the start of the month, but I wanted to show the monthly charts again this week, but I'm showing them of individual markets, which we didn't last week. You might recall last week were just ETFs and the broad asset classes such as EFA and EEM. But on the right-hand side, I wanted to show 10 individual markets with developed markets down the center, and then a lot of the BRIC markets on the right-hand side, or Brazil, Russia, India, and China. The point being, if you look across these charts, which again, go back over 5 years, you can see the strength we've seen recently in these markets. DAX in Germany, for example, has had a decisive breakout and back on a couple thousand points. You can see the ETF that represents the French market strong as well. Even the lagging UK market, which has had Brexit issues and a lot of bearish sentiment and some downtrends for quite some time, broke its downtrend recently, which is definite improvement for that market. Japan continues to lead the way higher, as does Korea. And regarding the BRICS, some of the best markets out there are those in China and India. So again, the bottom line being, the overseas markets continue to look strong, and they're really led by those in Asia. Lastly, I would like to show our weekly COVID slide, and there are a couple interesting things on it this week. First of all, you can see that thankfully, new cases and deaths are lower to flat, which is of course good news, and I'm sure something you're hearing about in the media. What's interesting is that COVID-related deaths now qualify for the $9,000 in funeral expense reimbursement from the government. There was a lot of speculation about this many months ago, and speculation that maybe COVID deaths were being categorized as COVID deaths when maybe they weren't being, to qualify for government subsidies. And now we're seeing those subsidies be real. For D here, there was a study per the Bellwether Education Partners that came out that said since COVID started, 3 million students have stopped going to classes altogether. So again, basically the school-age population of Florida stopped going to school altogether since the pandemic started. Hopefully something that will be rectified in the very near future. Finally, I wanted to point out the bottom left of the chart. These are the death rates per age group by COVID, and the overall death rate at the bottom, which is 50 basis points. So while certainly a tragic disease and something that has gripped our country for quite some time, it's good to know that if you do catch COVID, the chance of passing is 0.5%. Now, certainly those statistics are focused on the 65 and older age group, which is tough for that age group, but overall, still only 0.5% chance of an American citizen passing if they catch COVID, which is probably why the chart above it is trailing off. The orange line is the 7-day average of doses of vaccines administered. So again, while we've had a lot of doses administered, the rate and the increasing number is starting to fall off. So in summary, it was another good week for the markets, specifically, or in particular, I should say, the commodity markets. The Bloomberg Commodity Index remains strong. You're clearly seeing a trend of strong reflation here. And again, I think inflation, not just reflation. It's being driven by copper, which is a very economically sensitive metal at a 10-year high, and that's good news. You're seeing interest rates match the strength in commodities, which again is confirmation that there is real growth out there. And you're, interestingly, for the first week in many, seeing precious metals turn back up. As for stocks, the S&P did push through 4,200 last week slightly, but stepping back and looking at the comparison between the S&P and the NASDAQ, we are seeing some current concerns on the NASDAQ internally, and that it's not quite confirming the strength in the S&P. I put the daily charts on the right. Again, you can see the strength in the daily charts on the S&P and a little bit less strength in the NASDAQ. Finally, these markets are in healthy, longer-term uptrends with Asia leading the markets higher. I've been Mike Hurley with your weekly market deep dive for May 10th, 2021. If you have any questions at all on our brief, please let me know or send your representative a note and we'll get answers to you. I hope to see you next week.